Welcome to the Deep Dive, the show where we really cut through all the noise and get straight to what matters, helping you stay informed fast.
That's right.
Today we're diving into HDFC Life Insurance Company Limited, specifically their Q1 results for fiscal year 26.
Yep, first quarter.
We've got the regulatory filings, the press release, the investor slides, even the analyst call recording. We've sifted through it all.
And our job today is really to help you make sense of it all. Not just, here are the numbers, but what do they mean?
Exactly. What do they tell us about HDFC Life and, well, the bigger picture in Indian insurance?
We'll try and connect those dots, answer some questions that maybe aren't obvious just from reading the reports, give you that context.
Okay, so let's get into it. How did HDFC Life actually do last quarter? What's the headline?
Well, looking broadly, it was a pretty strong kind of all-round performance.
Okay.
If you look at their main growth engine, the individual annualized premium equivalent, that's APE, basically new policy premium.
Not the new business.
That grew 12.5% compared to last year. And if you look over 2 years, that's a compound growth rate of 21%. So pretty solid momentum.
It's quite strong, yeah. And the bottom line, profit.
Profit after tax, PAT, that was up 14%, came in at 546 crore rupees.
Okay, so top line growth is definitely feeding through. What about the money they manage, the AUM?
Assets under management, yeah. Also healthy growth there, up 15%, hitting, nearly 3,056,000 crore rupees. Big numbers.
Huge numbers. But how does this stack up against the competition? Are they just growing with the market or?
Good question. No, they're actually outperforming, gaining market share.
Really? How much?
Overall market share went up by 70 basis points. That's 0.7% for you listening.
Okay.
It takes them to a new high, 12.1% of the total market. And just looking at the private players, they gained 40 basis points, hitting 17.5% share there.
So they're definitely taking share. What's driving that? New customers.
Seems like it. Get this, over 70% of their new customers in Q1 were totally new to HDFC Life. First-time buyers with them.
Wow, 70%. That's significant.
It is, and it shows they're making inroads not just in the big Tier 1 cities, but also, pushing deeper into Tier 2 and Tier 3 markets.
Okay, that market share gain is definitely impressive. But growth is one thing. Profitable growth is another. Let's talk margins.
Absolutely.
How did their new business margins, the NBM, hold up? Especially with, new regulations around surrender values and their own investments.
Right, so the NBM actually edged up slightly, just a tiny bit, from 25.0% last year to 25.1% this Q1.
Okay, so stable, basically. But why is that significant?
Well, it's significant because they had headwinds, right? Those revised surrender rules. That knocked about 30 basis points off the margin potential.
Okay.
Plus, they're investing heavily. You mentioned Project Inspire, their tech platform, and they added, 117 new branches last year. That costs money up front.
So the fact they offset those costs and the regulatory hit?
Exactly. They did it mainly through a better product mix, selling more profitable stuff. It shows real discipline. They're choosing to reinvest those potential margin gains back into the business for the long term.
That makes sense. A long-term play. And speaking of long-term value, what about embedded value? EV.
Yeah, EV also increased. It's now at 58,355 crore rupees.
And the return on that, the ROEV. They gave a rolling number, right?
They did. Operating review was 16.3%, but crucially, that's on a rolling 12-month basis.
Why is that rolling figure important for someone trying to understand this?
It's important because insurance results can be a bit lumpy quarter to quarter, seasonal effects. Looking at the rolling 12 months smooths that out.
I see.
It gives you a much clearer, sort of more stable picture of the underlying profitability over a whole year.
Got it. And underpinning all this, their capital position, solvency.
Very strong. Solvency ratio is at 192%. The minimum required by the regulator is 150%.
So plenty buffer there.
Loads of buffer. Yeah, very comfortable.
Okay, beyond the big metrics, let's look a bit closer at the financials. How are things like renewal premiums looking? Keeping existing customers paying?
That's looking very good, actually. Renewal collections grew strongly, up 19% year on year.
19%. That's robust.
It is, and that directly fuels what they call backbook profits. Those grew by 15%.
Okay, can you quickly unpack backbook profits for us? What exactly does that mean?
Sure. It's basically profit they make from policies already on their books, so premiums coming in from existing customers minus the related costs and claims for those policies.
Right, not the new stuff.
Exactly. So strong growth there means good customer retention, good policy management. It's a really stable income stream for them.
That's clear. Now, it wasn't all smooth sailing, was it? There was this tax demand mentioned.
Yeah.
Quite a large number.
Yeah, that's right. A demand related to GST, about 1,004,000 lakh rupees plus penalty. So over 10,000 crore. It's significant.
What are they doing about it?
They've filed appeals and they've also made some prepayments, kind of like a deposit while the appeal happens. It suggests they're contesting it quite strongly.
Definitely something to watch, though. Potential cash outflow down the line.
For sure, it's a watch item.
And separately, they also did something with their debt. Exercised a call option.
Yes. They repaid about 60,000 lakh rupees, that's 6,000 crore, in debentures early by using a call option.
What is a call option in this context? Why do that?
So a call option gives the company the right, but not the obligation, to buy back its own bonds or debentures before they mature, usually at a set price.
Okay.
Doing this suggests they're actively managing their debt. Maybe interest rates are lower now, so they can refinance cheaper, or maybe they just want to tidy up the balance sheet. It's generally seen as, prudent financial management.
Got it. Proactive debt management. Makes sense.
Yeah.
Okay, let's shift gears to the products themselves. The mix is always interesting.
Yeah, tells you a lot about strategy and customer demand.
So for Q1, what did the mix look like for individual new business premiums, the APE?
Okay, so unit-linked ULFPs, they were the biggest chunk at 38%. Then participating products, or PAR, at 32%. Non-PAR savings were 19%. Term protection was 6%, and annuities were 5%.
Okay, 38% ULPs. That actually surprised me a bit. There's been talk about ULP demand maybe cooling off, but it seems quite strong here.
It does, doesn't it? And you're right, HDFC Life's ULP mix is actually lower than the industry average.
Right.
But yeah, demand held up. The main driver seems to be just the continued strength in the equity markets. People are still chasing those market-linked returns.
Makes sense. What about the participating products? They were pretty strong too at 32%.
Yeah, they saw good traction. HDFC Life put it down to launching some refresh propositions, new versions of products, like something called Click to Achieve Par Advantage.
Okay.
And also, general economic uncertainty probably pushes some people towards products with guarantees and potential bonuses.
So a bit of a safety play alongside the market-linked ULPs.
Exactly. And they mentioned this refresh helped them with sharper need-based selling, especially to older customers and in those tier 2 and 3 towns.
Interesting. But what about non-par savings? That seemed a bit lower, moderated, they said. Are they pulling back there?
It's definitely a conscious choice. They were quite clear in the commentary. They fundamentally believe in staying away from irrational pricing.
So avoiding a price war.
Pretty much. They see some competitors being very aggressive on pricing in non-par, and they're choosing not to play that game if it means sacrificing long-term profitability. Discipline again.
Right, quality over just chasing volume in that segment.
Exactly. But look, where they are focusing, like retail protection, that grew faster than the company average, up 19% year-on-year, and a 23% two-year KH Sure. They're a leader there in terms of total sum assured.
Okay, so strong in protection. And Credit Protect recovered too.
Yeah, helped by more loans being given out generally. And they've been innovating too, launching new protection products like Click to Protect Ultimate and Super and Elite Plus, plus that new Par Savings product we mentioned.
Okay, so a very deliberate product strategy. Now, how are they selling all this? Distribution channels.
Always key.
Bank assurance. Selling through banks was the biggest, right?
Yeah.
60% of individual APE.
Yep, bank assurance dominates at 60%, then agency channel is 16%, non-bank alliances, that's brokers and other corporate agents, is 15%, and direct sales are 9%.
And all channels grew.
They said all channels recorded healthy growth, yeah.
With bank assurance being so dominant, especially with HDFC Bank, obviously, what's the focus there? Just pushing more volume?
Not just volume, they talked about enhancing channel economics.
Right.
Which basically means making the partnership work better for both sides.
Yeah.
Things like diversifying the type of products sold through banks, not just the easy sells. Better cross-selling and upselling. And using more digital tools to make it smoother, more integrated.
Okay, deeper integration. What about the agency channel? 16% is still significant.
It is, and it showed decent growth, a 10% two-year CAGR, even though the agency channel across the industry has been a bit uneven after some regulatory changes.
Right.
HDFC Life has actually started a big transformation program for their agency force, aimed at getting agents more active, more productive, making it a more viable career long-term.
Are they adding agents too?
Oh, yeah. Added 23,000 new agents just in Q1, so still investing heavily there.
Okay. And you mentioned non-bank alliances is now a combined category.
Yeah, they've grouped brokers and other non-bank corporate agents together. They said it's for more meaningful disclosure. Makes sense.
All right. Let's look at operational health now.
Okay.
Persistency keeping customers on the books. How did those numbers look?
Pretty healthy overall. The 13th month persistency, so people sticking around after the first year, was 86%.
Okay, that sounds good.
And the 61st month persistency 5 years in was 64%.
Are there any details behind those numbers? Any slight shifts?
There are a couple of nuances. The 13th month one, 86%, was actually down just slightly, about 1%.
Oh, why is that?
Mainly because fewer large ticket policies were sold after those tax changes we discussed earlier. But, and this is important, they said this was already baked into their calculations. They expected it.
Ah, okay. So no surprise to them.
Right. And on the flip side, the 61st month persistency actually improved, which is great news.
Why did that improve?
They put it down to better retention on their long-term savings products. People holding those policies for the long haul are sticking with them. Good sign.
Definitely. What about the actual number of policies sold? NOP growth?
That was a bit weaker in Q1, but again, apparently that was a conscious decision.
Yeah, so.
They deliberately slowed down sales in some lower ticket size segments to, focus resources on more profitable business.
Okay, that profitability focus again.
Exactly. They expect NOP growth to pick up later in the year as they rebalance things.
Makes sense. Thinking bigger picture now, the regulatory environment. Seems things might be settling down a bit, more consultative.
That seems to be the feeling, yeah. A more stable environment. And the industry itself is tackling issues like mis-selling more proactively.
And on a different note, something quite impressive, their ESG rating got upgraded.
Yes. MSCI bumped them up from A to AA, that's a really high rating, puts them among the top insurers in India, even the region, on environmental, social, and governance factors.
That's significant recognition. How does that fit into their strategy?
Well, it's not just a badge. It reflects, a real commitment to responsible operations that increasingly matters to investors, to customers, builds long-term trust, and potentially attracts capital. It aligns perfectly with that long-term value focus we've been talking about.
Right. So, pulling it all together, what's their outlook? How did this Q1 fit with their own expectations?
They said Q1 growth was pretty much bang in line with what they expected at the start of the year, even though Q1 last year was a tough comparison because it was so strong.
Okay.
Looking ahead, they expect a more balanced contribution from both the size of policies and the sheer number of policies sold.
And for the full year, what's the guidance?
Guidance is for growth to be, in their words, relatively softer than the 18-20% they did last year, expecting a slower first half than a pickup in the second half. Partly base effects, partly just the economic fundamentals kicking in.
And margins for the year?
Expected to be range-bound for the full year, so probably similar levels to now, but they do see scope for margins to expand over the next, say, 3 to 5 years.
So steady for now, expansion later. And the overall ambition?
Still aiming to grow faster than the industry overall and stay in that top 3 group of insurers in India.
And they're betting on tech to help get them there. You mentioned Project Inspire.
Hugely. Project Inspire is about building this next generation platform. Think zero-touch processing, instant policy issuance, same-day claims payments, real-time payouts. Very ambitious.
Wow.
And they're pushing hard on Gen AI too, using it for things like a product GPT to help customers, generating marketing content, better chatbots, even using AI for things like digital life certificates and creating personalized sales pitches for agents.
They're definitely investing in the future there. Okay, so wrapping this up, what does this all really mean for you, our listener?
Well, I think HDFC Life's Q1 results show a company that's navigating a pretty complex market very strategically.
Yeah, it feels very deliberate.
Right. Balancing that growth, but with a real eye on profitability, keeping the financials strong, focusing on the customer, but also making these big bets on innovation for the future. It's that long game approach again.
A picture of strategic agility, really.
I think so. And maybe a final thought for you to consider. Given HDFC Life's really disciplined stance on pricing, especially in segments like non-par, and this heavy focus on long-term value and innovation, how might those choices start to shape what competitors do? Could it influence the broader competitive dynamics, maybe even product innovation across the whole Indian insurance sector in the years ahead? Something to mull over.